You know, if you spend any amount of time looking at financial institutions and their history, you will observe that every so many years, these financial institutions go through a crisis. And then after the crisis is over, there's an autopsy, there's an investigation. And soon afterwards, there's regulation. And the regulations are meant to try to plug the holes that were in the system previously that caused the crisis. And then a few more years later, there'll be another crisis, and they try to plug the holes with regulations, and it just continues and continues and continues. And then what you observe after a while is that, well, you know, some of this regulation actually caused some of these crises, which is quite interesting. The purpose of this video is to cover the business models of various financial institutions at a fairly high level. I'm going to cover banks, which we've done before, but I'm going to look at it from a regulatory point of view in terms of crises that have hit banks. I'll do the same thing for insurance companies, mutual funds, and shadow banks, and I'll emphasize a balance sheet approach. Again, it's a fairly high-level view. I'm treating banks as being pretty uniform, but you know, some of them can be quite different. The same with insurance companies, the same with mutual funds. I just want to get a high-level overview of what's going on in these institutions that cause the need for regulation. So now let's look at a bank balance sheet again. So let's orient ourselves with a bank balance sheet. A regular commercial bank, there's demand deposits, sometimes called transaction deposits. Let's call it $90. Equity or capital of 10. So we have liabilities and equity of 100. We'll have reserves, and we'll set a reserve requirement of 10%, as we discussed before. And the bank's going to lend out everything it can, and this will have to be 91. And in this case, we'll have 100 in assets. So first off, we have reserve requirements because the bank holds reserves, and banks also have capital requirements, so they have enough equity relative to total assets. This is in the simplest way of computing a capital ratio. Okay, so we have those two requirements. Now, why are those requirements there? That's what we want to ask ourselves. Well, the reserve requirements, as we've discussed before, are used to prevent runs and allow a bank to be able to withstand a bank run. So what happens in a bank run? Well, people start lining up and they start pulling their money out of the bank. And if you only hold 10% in reserves as backup, it won't be long before you run out of liquidity, and then you got to try to liquidate your loans. And loans are not that liquid. And you run into a liquidity problem, that can cause major problems for the bank. Now, why would there be a run on a bank? Well, part of the problem is there's asymmetric information here. Depositors don't really know what type of loans the bank has made. Remember, banks keep it secret. So depositors put their money in, and if they hear a rumor about the bank not being solvent or having some problems with big loan losses, they're likely to line up and start pulling their money out sooner rather than later because it's on demand, first come, first serve. Now, how do you resolve that? Well, that's where the FDIC comes in, and we'll talk about in a later chapter, in a later video, the Federal Deposit Insurance Corp. That comes into play, and that says, look, these deposits are insured up to $250,000 per account, per institution. In which case, you don't have to worry about your money here. It's going to be safe. It's federally insured. And that by itself is a pretty strong statement. And it allows the bank to hold a minimum amount of reserves so the bank can remain profitable and operate and, serve the community like it's supposed to. So in the 1930s, when we had a banking crisis, there were huge runs on banks at the time. And that was before we had FDIC insurance. FDIC insurance came about in the Great Depression in the 1930s. As a result of so many people trying to pull their money out of the banking system, it literally collapsed the banking system. We had to have a banking holiday for a few days to sort things out. And the FDIC was born. So there's an example of a crisis, the Great Depression. Now, also what happened in the Great Depression and many, many recessions that we've had is these loans go bad. And these loans go bad the value drops off. It reduces capital because remember what capital is. One way to calculate it is you have a beginning balance of capital. Let's call it retained earnings to be specific. So you got beginning retained earnings. Then you have net income. If it's positive, it adds to the capital that's in the bank. And then there's dividends. And then you have an ending. So this is, you call this beginning retained earnings, call this ending retained earnings. And that's a negative sign. I should get rid of this. You don't need it here. So net income adds to your capital. Dividends subtract as the bank pays dividends to its shareholders. And then you have retained earnings. It's all part of this equity component. Well, what happens if your net income is negative because you had some huge loan losses? This becomes negative. It reduces your retained earnings, which reduces your equity, and next thing you know, your capital ratio of equity to assets is down significantly, and you have a solvency problem. You could go bankrupt because of that. That's why there's lots and lots of regulations by the Federal Reserve and other institutions that oversee banks to make sure that their loan portfolio is well diversified and that it's managed properly in terms of interest rate risk. Remember that story of interest rate risk. These are short-term deposits. These can be yanked out at any time, and these guys generally pay no interest. So imagine what happens if interest rates in the economy go up significantly. People are going to start withdrawing their money. It may not happen fast. It may not be in terms of a bank run, but if interest rates go up, banks are going to get strangled from a liquidity perspective, because people are just going to pull this out. Meanwhile, loans are stuck. The loans can be long-term. Some of them can have maturities of years, and if it's residential mortgages, decades. So as you can see, if interest rates go up, now you have a liquidity problem in and of itself. And that's exactly what happened to savings and loans, but from another angle here. So here we had savings and loans, and if you recall, savings and loans specialize in making residential mortgages. They take deposits, like demand deposits, but they have mainly residential mortgages on their books, which means they can potentially have some really big problems because these deposits can be pulled out very, very quickly. But these mortgages, if nearly all of the portfolio is in decades-long maturity mortgages, you can see that there's a substantial problem there. And that's exactly what happened. And started in the late 60s. All the way through the early 1980s, interest rates rose dramatically. People started to pull their money out because the deposit rates were too low. And then the S&L, and in this case even the bank, could not generate the liquidity that they needed. They couldn't get the money they needed to fund these mortgages, so they had problems. Now, you might want to ask, well, why don't the banks just raise the interest rate on their deposits? And if they did that, maybe they could become profitable. Well, a couple of things. When interest rates go up and you start paying higher interest rates on your deposits, and these loans were made years ago and these mortgages were made years ago under a low rate environment, that means this side of the balance sheet, whichever institution you're looking at, is generating, has assets with very low interest rates and returns, while your interest expense is very, very high. Right there, you can see that there's a problem. Your spread, your net interest margin, will end up being negative. The other issue is, again, talk about regulation. What was born out of the Great Depression in the 1930s was interest rate ceilings on banks. Banks were not allowed to pay. Interest rates on demand deposits and other types of deposits had ceilings on them. So both banks and savings and loans could not pay very high interest rates, and the interest rates, the limits that they set in the 1930s, were based on inflation and interest rates up in around the 1930s. Well, in the late 60s and 70s and early 80s, inflation ramped up. So remember, your interest rate is a real rate plus an inflation premium. Well, inflation skyrocketed, interest rates skyrocketed, but the banks were not allowed to increase their interest rates that they paid on deposits. That's why people skipped out. They just pulled their money out of a bank. Where did they put it? Well, that's the story. We'll talk a little bit in a few minutes about money market mutual funds. They paid higher rates of interest than a bank because they're not regulated. It's part of the shadow banking system. And so there you have it, a regulation causing a problem in and of itself. By the way, those interest rate ceilings were meant to prevent banks from competing too hard against each other, because the thought was, well, if banks really compete hard, they're going to pay such high interest rates, they're going to drive themselves out of business. Yeah, that was the thinking. And then the other part of the thinking was, well, if there's FDIC insurance, then taxpayer and the federal government is on the hook for these banks that go belly up. So you can see the FDIC insurance and the interest rate deposit ceilings and the fact that they didn't want banks to compete too heavy all kind of ties together. Now, let's look at insurance companies in general here. Insurance companies are diverse. You got property insurance, you got life insurance, you got disability insurance. I'm just going to try to paint them all with one brush. That's why I said in the introduction we're going to do a high-level review of these institutions. So let's look at an insurance company. Insurance company collects premiums, right? It collects premiums and then it buys bonds, and it can buy some stocks and other assets, and that's the asset side. Lots and lots of bonds, less stocks. And then on the liability side is liabilities for those potential payouts that they're going to have to make. And so if it's life insurance, you're going to have a bunch of actuaries. Well, you're going to have actuaries no matter what type of insurance is out there, but life insurance is a little easier to wrap your head around. Look, they're going to project all of the people that they have insured. They're going to look at their age, figure out when they're expected to die, and then estimate this liability. And sometimes this liability is called reserves. From an insurance perspective, the reserves on this side of the balance sheet. And then the reserve idea is that, look, the state regulators, and by the way, that's who mainly regulates insurance companies, is state regulators. They want to make sure there's enough reserves on the insurance company's books to be able to handle a catastrophe. And like, what kind of catastrophe or crisis could hit an insurance institution? Well, let me give you an example. Let's say you're a property insurance company, homeowners insurance. Let's say homeowners insurance, and you insure all of the state of Florida. That's your entire business, just Florida. And so you have billions of dollars tied up in the insurance of homes in Florida, and a hurricane comes through. And the hurricane goes right up through the center of Florida and destroys billions and billions of dollars worth of homes, to the point where, look, these liabilities all come due at the same time. It wasn't like there was a house fire here and a house fire there and they could pay out slowly. This happened all at once. Likely the insurance company wouldn't have enough liability set up, wouldn't have enough stocks and bonds, just wouldn't be able to handle it, and the insurance company would go belly up. So insurance companies have to be diversified to some extent and prove to regulators that they are reasonably diversified to withstand a shock, like a hurricane in this example. So what else could get an insurance company in trouble and face a crisis? Well, let's rewind to the early 2000s. In the early 2000s, some insurance companies, a really good example would be a company called AIG. AIG started to get away from this general insurance, traditional lines of insurance, and they started to sell credit default swaps. CDS, credit default swaps, basically is like an insurance policy for credit. And what do I mean by that? It's basically this insurance company would insure other companies' credit and bonds. So if a bond would default or have a downgrading, so there's rating agencies that rate the quality of the bond, let's just say, AAA, AA, single A, and so on, B, and if there's a downgrading, then the price of the bonds drop dramatically. Well, this AIG, what they started to do is they started to insure bonds and companies, the company as a whole, for any credit event, where a credit event would be a default on the bonds, or it could be a downgrading, as two examples. Well, AIG started to sell billions and billions of dollars worth of credit default swaps. So much so that when we got into the Great Recession and companies started to default and they had credit events, AIG couldn't pay off all its liabilities that it had. It just didn't have the money to do it because it just simply overextended itself in issuing credit default swaps on financial institutions. And financial institutions are the things that really got hit in the Great Recession from a liquidity crisis. I mean, remember, it was a liquidity crisis that happened. Where was the main problem with liquidity? In financial institutions. They weren't liquid. And so those credit default swaps were triggered. AIG couldn't pay it off, and the U.S. government had to take AIG over to try to calm the financial markets down because they couldn't let it fail because it was one of these guys that's called too big to fail. It was a gigantic company and still is at this point. Now, let's move over to mutual funds, which we haven't spent much time on. It's covered mainly in investment management. But a mutual fund works like this. They have very little liabilities. Nearly everything is equity here. And so shareholders like you and I, we don't want to manage our money ourselves, for example. We don't want to buy the stocks and figure out which stocks to buy and which ones to sell and which bonds to buy and so on. So we send our money into a mutual fund and they manage it professionally. And they have a prospectus and an annual report that tells you this is what we invest in and this is how we manage our money and so on. So you know what you're getting into. These things are regulated by the Securities and Exchange Commission as one of the primary regulators. And so these could be bond funds. They could have billions of dollars in bonds. They could own 1,000 bonds or more. They could own 1,000 stocks or more, depending if it's a stock or a bond fund. Sometimes they're called balanced funds if they own both bonds and stocks. And so you invest and you're an equity holder, and then you get the return from these stocks minus the expenses to manage the mutual fund. Extremely, extremely popular. We spend quite a bit of time on it in investment management. It's probably the way to go when it comes to your retirement money and where you want to put your 401 money. So now let's ask the question, well, what can go wrong with this? Well, these things are fairly sturdy, and here's what I mean by that. They're not leveraged up. They have almost no debt here. For the most part, they don't borrow money. They may have some liabilities like, they may have redemptions payable. People may want to withdraw their money out and they haven't paid it yet because there's a delay in timing. Or maybe they purchased a stock or a bond but haven't paid for it. And so they'll have bits of liability, but nearly everything is equity. So what happens is, these things, like I said, are fairly sturdy. So you have a big drop in the stock or bond market, it wipes out equity, but it doesn't have a contagion effect to any significant degree here. You just get whacked as a shareholder. Your shares may go from initially being $10 a share and they drop down to $3 a share and you take a loss. Now, a specific type of mutual fund is a money market mutual fund. We looked at this when we talked about shadow banks earlier. And what money market mutual funds do is this. They buy money market securities, repos, commercial paper, and asset-backed commercial paper, which is short-term debt, and they'll buy, T-bills and even municipality money market securities. And what they do is they have equity, and they sell their equity at $1 per share. Now, the asset value here, the equity in a regular mutual fund, that can gyrate back up and down, like I said, $10 to $3 here. But with money market mutual funds, they have what's called a buck pricing. The pricing is $1. So it's $1 times the number of shares outstanding. These things don't borrow money for the most part, so they have almost no liabilities here. And so what happens is these things are very short term, generally very, very low risk. And so they generate a return, and whatever return is earned minus the expenses for today, for a single day, is that this mutual fund will declare a dividend. So it'll declare an itty-bitty little dividend every single day. But the shares will stay at $1, so you'll always have that $1 price, and then you'll keep getting dividend income over time. Now, what can go wrong with this? Well, it's the bundler type story that we talked about. Another type of shadow bank. Oh, and by the way, this is a shadow bank. Remember, this is a type of shadow bank because, look, it's a way to have checking. So basically there's checking accounts here that you can write checks quite easily, and that's why these money market mutual funds came into business. They wanted to compete with banks. So you basically put $1 in a bank and you're going to get $1 back, and you may get a little bit of interest, but it was very stable. So money market mutual funds came about by saying, look, we're going to have a $1 price always, and we'll just declare a little dividend each and every day. And you can write checks against this because, look, these repos mature overnight. This commercial paper matures very quickly, and the T-bills mature very quickly. These are very liquid. We can sell these things on a dime very quickly. And so if you withdraw your money because you're writing checks, do it, because that's what we're here for. Okay? So they have the liquidity to set up here with no leverage effects. And they don't have to worry about loans defaulting for the most part. Okay? But it's not foolproof. And the problem had to do with this asset-backed commercial paper. So remember, we talked about bundlers. Bundlers buy residential mortgages, package them into residential mortgage-backed securities to be sold as bonds. And how do they fund this process? Well, we said that, look, they issue asset-backed commercial paper or repos, which are what these institutions buy. So these are liabilities to a mortgage bundler, or it could be a credit card bundler or a student loan bundler. And then these guys, these money market mutual funds, end up buying them as assets because they generate a nice return. And then people like you and I buy these money market mutual funds, and we can write checks and get money market interest rates that go up and down, whereas your typical bank, pretty much has very stable interest rates. The interest rates don't gyrate around a lot, especially years ago when there were interest rate ceilings. So these things came about when there were interest rate ceilings, because there's no interest rate ceilings on money market mutual funds. They came about by dodging regulations, and they don't have capital ratios because nearly everything's capital. Interesting. These guys don't really have capital ratios, and they don't have to worry about deposit insurance because there's no deposit, and the deposit runs, there's no deposits. And here, these are kind of like deposits here. But look, everything is super liquid on this side, so it doesn't matter if you pull your money out. So that's how money market mutual funds came into being. And so in the early 2000s, we got these bundlers coming about, buying mortgages from banks, so banks could get mortgages off their books and get fresh cash. This bundler would process these residential mortgages, produce residential mortgage-backed securities. It would take several months, about the same time as these things would mature. So these things would mature in several months. About the same amount of time it would take to process these and sell these mortgage-backed securities. But remember what happened in 2006 and 2007. We had the subprime crisis, the liquidity crisis, and what happened was these mortgage bundlers ended up getting whacked with defaults on residential mortgages. And nobody wanted to buy a residential mortgage-backed security. They were like off limits because of subprime lending. There were a lot of individuals, lots of individuals across the country that couldn't pay back their loans. They lost their job and they lost their ability to pay off their mortgages. So they went in default. And they went in default. The bundler here had a big problem and started losing money, and these assets dropped in value. Well, they couldn't get the cash flow to pay off their commercial paper and their repos, which means the money markets got in trouble because now these assets here, they're in default. And they were in default enough to what's called break the buck. There were a few mutual funds that dropped down. Now, it didn't drop very much. They dropped down to 99 cents a share, but it freaked a lot of people out. And they couldn't even trust money market mutual funds. So the government had to insure money market mutual funds for a while to make sure that people wouldn't liquidate their money out of the money market mutual funds and cause all sorts of problems and cause these institutions to fail, along with the banking system. So you can see things are tied together very closely with financial institutions, which is one reason why they tend to be heavily regulated. If one financial institution goes down, they tend to be all linked and tied together, and it causes a domino effect. Now, these bundlers are shadow banks. They don't take deposits, but they're acting in the mortgage business just like a bank does. And they don't have capital ratios. They just don't have them. They measure them, but there's no regulator saying you need to have a capital ratio of X%. They just don't have them. So that's why they're shadow banks. They're doing stuff. They're making these loans and dealing with these loans without taking deposits and without having to deal with deposit insurance, and then without having to deal with capital ratios. And there's one other type of institution we can look at real quick, and that's a finance company. So finance companies, generally speaking, they issue consumer loans. So that's their asset here, consumer loans. And they issue repos, and they issue commercial paper, which could be asset-backed commercial paper. Remember, asset-backed commercial paper here and here means that this commercial paper has collateral. The collateral is these mortgages, basically. And so here, the collateral for this commercial paper would be these loans. And then if you're a very well-known financial financial institution, then you can just issue commercial paper without it being backed by any collateral, because your name is a household name and you can just generate credit quite easily. So here's a finance company, but notice it's not taking deposits, so it doesn't have to worry about reserves, just like these guys don't have to worry about reserves, and these guys don't have to worry about reserves, and these guys don't have to worry about reserves. This finance company doesn't have to deal with reserves. It doesn't have to deal with capital ratios as being highly regulated for the most part. So this is another type of organization. Look, they're stealing some of the business from banks, which is why it's called a shadow bank. These guys are taking deposits. They're just not calling them deposits. These guys are dealing in residential mortgages and bundling them and bundling credit cards, which is what banks do also, and so on. And so this finance company is extending loans, but it has no deposits. And not only that, it's not likely to have capital ratio requirements. There's no regulator watching over this finance company. With this background, as you can see, we've got a general background. Here are various financial institutions. Here's what their balance sheets look like in general. Here are some of the crises and problems that they can face. And then here's some of the types of regulations that they have. So think of this video as a prerequisite for understanding regulation down the pike in this course. Because as I said before, you can't begin to understand the spaghetti-like regulations that we have, the hodgepodge, patchwork quilt type regulations that we have, without understanding the history of financial institutions, the various crises that have whacked them over the years, the investigations and the autopsies and the regulations that follow. The regulations that follow often were knee-jerk reactions to what happened. And not only that, but later on, it turns out that regulation, which was all meant well and good, turned out to cause substantial future problems because it tied the hands of the financial institutions that it was meant to help. So I'm about to show you a chart. Don't even think about trying to focus in on it. It's too hard. It's a bit blurry. And the point is, just look at the overlap and all of the connections and links that are here. And I'll explain in a second what it means. To give you a high-level view of what the regulatory environment looks like today for financial institutions, here is a chart that came out of J.P. Morgan's annual shareholder letter. J.P. Morgan is one of the largest financial institutions in the country. Its CEO, Jamie Dimon, is not pleased with the type of regulation that's going on in financial institutions, especially since the Great Recession. So he writes this. He says, as a result of Dodd-Frank, which was thousands of pages of regulation that came out of the Great Recession, in 2010, 11, 12, it took many years for it to be written. It says, as a result of Dodd-Frank, we now have multiple regulatory agencies with overlapping rules and oversight responsibilities, as you can see from the chart. Although the Financial Stability Oversight Committee was created, it is proving to be too weak to effectively manage the overlap and complexity. We have hundreds of rules, many of which are uncoordinated and inconsistent with each other. While legislation obviously is political, we now have allowed regulation to become politicized, which we believe will likely lead to some bad outcomes. That narrative was written in 2012. So as I've said before, I basically skimmed the surface in this analysis of what happened in the financial crisis and the institutions that were involved. If you ever want more details, go to the final report of the National Commission on the Causes of the Financial and Economic Crisis in the United States. It's only 663 pages, and it gives you a lot more details than I gave. So the funny thing is here is you have asymmetric information among the various regulatory bodies that look at financial institutions. So you have that asymmetric information, and you basically have a free rider problem. Well, the Fed's looking at this, and so we, as the FDIC, don't have to look at it as hard, and the Fed is saying, well, the FDIC is looking at things carefully, so we don't have to look as hard, and then things fall between the cracks. So here are some of the conclusions from the report. This financial crisis was unavoidable. Widespread failures in financial regulation and supervision proved devastating to the stability of the nation's financial markets. So right off the bat, they're pointing the finger at financial regulation, the spaghetti work. Then it says dramatic failures of corporate governance and risk management at many systematically important financial institutions were key to the crisis. A combination of excess borrowing, there's that leverage thing, risky investments, subprime loans, residential mortgages, and the lack of transparency put the financial system on a collision course with crisis. There was a systematic breakdown in accountability and ethics, collapsing mortgage lending standards, and the mortgage securities pipeline, that's buying, the bundlers buying residential mortgages and packaging them into residential mortgage-backed securities. It lit and spread the flame of contagion and crisis, which is basically what I showed you, contagion. Everything's connected. Over-the-counter derivatives contributed significantly to the crisis. What are they? Well, those are good examples. That is credit default swaps that I talked about. Many of those instruments were traded over-the-counter market. In other words, they weren't traded on a stock exchange or an exchange. Then the failures of the credit rating agencies were essential cogs in the wheel of financial destruction. Now, what are the credit rating agencies doing here? Well, let me show you. So how do the credit rating agencies work into what we just saw here? Well, these are the bundlers. They buy residential mortgages. They package them into residential mortgage-backed securities. These are bonds. These are bonds purchased through by you and I, people like you and I, through brokers, or a lot of mutual funds bought them. And we are not going to buy these residential mortgage-backed securities, and mutual funds aren't going to buy these bonds unless we're comfortable that they have a good credit rating. And so that's where the credit rating agencies come into play. They evaluate and rate the creditworthiness of these bonds. And what they did was they gave them AAA ratings, very, very high ratings, which basically said the chance of credit default on these things and people losing money by buying these bonds is close to zero. Well, obviously that wasn't the case. And so the next question is, well, why did they give them such a high credit rating? Well, they misinterpreted the market, for one thing. They thought the housing market would continue to go up forever, and that meant that these residential mortgage-backed securities will never fail. Why? Because even if people default on the mortgages, then the banks and the institutions will take over those properties and sell them for more money than what the mortgage is worth. So no matter what happened, these residential mortgages would be good. The other thing is the bundler would pay the credit rating agencies to rate these bonds. Whoa, stop right there. There's a conflict of interest because the bundler is paying the credit agency to rate those bonds. And so the credit rating agency would give them a good credit score because the bundler would go and say, look, if you can't give us a good credit score on these, then we'll just find another credit rating agency to do it for us. And so the competition for rating various bonds was fairly strong, and the bundlers had an upper hand in that instance. And so the integrity of the credit agencies was very much in question. Keep in mind that they evaluate more than just residential mortgage-backed securities. They put credit ratings on trillions of dollars worth of bonds. So there you go. We covered a lot in this video. We looked at various financial institutions from a high level. We looked at the regulation that was involved, and we saw that a lot of the regulation came from various financial disasters that happened in the past, going back to the Great Depression, going back to the savings and loan crisis that happened in the 70s and 80s, and then looking at the crisis from the Great Recession. So all of those disasters that happened created even more regulation on top of the old regulation. So don't think for a second now that all this regulation is going to stop a future crisis. And you know what? I've been around long enough to tell you this. There's another financial crisis coming down the pike. I don't know when. I don't know how it's going to happen. But I can tell you there'll be another financial crisis. There's going to be more regulation that comes out of it. Now, don't get me wrong here. Regulation is a burden. It's overlapping. It's redundant. But you know what? It's absolutely necessary to have regulation for a well-functioning financial system. It's just that it would be nice if it was done efficiently.